It would be, I'd be remiss to not call this a tricky moment for the market. See, the economy's slowing. Commodity prices are coming down. And many classic cyclical stocks have been struggling. All signs of the need for a rate cut. People are suddenly much more worried about a slowdown or even a recession. But on the other hand, we're also waiting eagerly for the Federal Reserve to cut interest rates and bolster the economy. The worse the data gets right now at this moment, the higher the probability that the Fed takes action. And when the Fed starts cutting rates, it's the economically sensitive cyclical stocks, which have been punished and are being punished, that win. At this point in the business cycle, where we're torn. We're torn between worrying about the economy and salivating over the prospect of lower rates. You absolutely need some cyclical exposure right here, but it pays to be selective with your picks. You know why I've been thinking about this? Because I think a lot of stocks don't fit the pattern. So why do I do this? Let me give you 5 industrials that I think are still beating the market this year because they're no longer pure smokestack stocks. They've given investors new reason to own them, though, in a changing world. I like these, and it solves a lot of the dilemma for me about what to recommend to you right before we have to cut. First up is Cummins. We had them on very recently. This is best known as a maker of truck engines. If Cummins were still a pure play on trucks, no desire. Trouble right now. After 2+ years of freight recession, truckers aren't exactly flush with cash. In the first half of the year, sales of Class 8, that's the big guys, trucks were down more than 16%. That's rather remarkable versus the same 6 months in 2023. That's why they're calling it a freight recession. But Cummins actually hit a new all-time high earlier this month because it's no longer the Cummins of old. For starters, these guys have definitely managed the energy transition, developing lower carbon solutions that work right out of the gate, like natural gas-powered engine platforms, as well as working on zero-carbon stuff for the future for electric and hydrogen engines. Now, in May, Cummins held an analyst day where they walked back some of their long-term targets for the zero-carbon business, while also raising the outlook for their core internal combustion business, which was more than enough to offset the damage. Now, I think that they've been smart about working on green engines without abandoning their traditional mainstays that run on gas or diesel. More importantly, Cummins has a thriving power systems business where they make generators and commercial power systems for buildings, including, yes, data centers, which are all being built all over the place. Even if truck sales have slowed, the data centers on fire. These are backup power systems. Remember, data centers can't afford to go offline during a power outage. When Cummins reported earlier this month, they delivered much higher than expected earnings, and power systems accounted for roughly 2/3 of that beat. I was shocked at that. I just didn't think it was that big. Now, we spoke to CEO Jennifer Rumsey on August 1 on Mad Money, and she explained that the data centers become a key source of growth for Cummins. Of course, after roaring that day, the stock sold off next week as the market turned on the industrials. But that just means you're getting an incredible quarter for free. Now, let's talk about a company that has changed its identity many times, but I really like the way it looks now. Let's talk about Dover, which used to be a classic metal bender, just like a textbook smokestack stock, frankly. In recent years, though, the company's transformed itself, become more secular, less cyclical, which is why we now own this one for the Charitable Trust. I'm proud of this one. I think it's going to have a big run. The new Dover now sells into some of the best secular growth themes of our era. Think lower emissions refrigeration and cooling systems. Think heat exchangers and thermal connectors. The data centers, I know, a lot on that, used to keep temperature down. Think pumps and processors for the life sciences industry. Even though this company's reported 2 straight beat and raise quarters, well, the stock's basically been trading sideways since March, as it's still seen its traditional smokestack name. Even though they've been reshuffling the portfolio again, they just got rid of some waste refuse division. I think the market's underestimating Dover, hence why we've been building a position in it for the Charitable Trust. I think it's going to have to be discovered over time. Third is another Charitable Trust name, Eaton, which is a major player in electrical power management systems, as well as making components for autos and aerospace. These guys benefit as the government makes major investments in the electric grid, which cannot handle all the power that needs to be produced right now. You also need their equipment to move manufacturing back to the United States. That's a mega trend. And, of course, these power management systems are essential for, yes, the data center. Eaton's gear can give customers visibility into their energy usage at all times. Now, while the stock has rallied hard at the beginning of the year, Eaton has stalled out big time since the spring, just like Dover, because of worries about a slowing economy. I think you're getting a good chance to buy it before the next big run. And, boy, this one is down a huge amount from the high. Painful for the trust, good for you. Fourth, how about Hubbell? No, I brought this one up a month ago. It's a company that makes equipment for utilities and large commercial users of electricity. As I explained last month, Hubbell's a play on the modernization of the electrical grid and the overall need for more power, both to support new manufacturing, especially for the data centers, again, by artificial intelligence. Too much data center, what can I tell you? That's the hottest segment. It's also a renewable energy play because Hubbell helps get power from solar panels or wind farms to the grid. That's very good. I like Hubbell, too. Now, at the end of July, 2 weeks after I recommended it, the company reported a solid quarter with a strong full-year earnings forecast. Even if the sales forecast was less optimistic, that was enough to send the stock up nearly 8% over the next 2 days. But then the market melted down, and that Hubbell gave back most of these gains. Again, so you're getting that latest quarter almost for free in a secular growth story. Now, I've got one last new one that I've been looking at. It's been driving me crazy. I watch it and watch it, watch it. I love Cleveland. I love Ohio. I love, love, love. It's called Parker-Hannifin, PH. That is currently up 24% for the year. Now, this is a company. What a quarter they were. Oh, my God. It's just like stars flying out of it. Here's a company that makes motion and control systems, along with filtration products, fluid connectors, and engineered equipment for aerospace and defense, industrial equipment, vehicles, heating, ventilation, and air conditioning, all the things that you probably don't want to do, but I don't care because it's really making a lot of money. Like the other companies I've mentioned tonight, Parker-Hannifin is shaking up its portfolio in order to double down on secular growth megatrends like aerospace, infrastructure, clean energy, semiconductor manufacturing, and again, the data center. Last week, Parker-Hannifin reported what may be the best quarter of any industrial company I follow. They posted 3% organic revenue growth. Wall Street was only looking for 0.3, pairing that with a 55-cent earnings beat off a $6.22 basis. Better yet, management gave a strong forecast for the new fiscal year. They're now in 2025, and 2025 is looking pretty darn good. That's why the stock jumped more than 10% last Thursday. I think it's got more room to run because there's just not a lot of shares out there. I mean, it's kind of like there's like nothing. If you try to buy it up like 100 points, that's not a lot of stock for sale. Let me give you the bottom line and what I think is one of the more exciting pieces, because this is where the action is at this point in the federal rate cut. Right here in this tricky market, people are giving up on the industrials, exactly the moment where they should be buying them because the rate cuts are on the way. Does anyone else have the textbook besides me? That's why I recommend the new industrials that have pivoted to powerful secular themes. I know I could have included CAT, but I've beaten that horse to death. But it's easier to stick with these when everyone else is panicking. And that's Cummins. We write these down: CMI, Dover, Eaton, Hubbell, and then Parker-Hannifin. They all benefit once the Fed starts cutting. In the meantime, they're holding up much better than the other smokestack names because they have gone secular. All right, you know what I'm going to do? I'm going to start with Stafford, who happens to be from California. Stafford.
Hey, Jim, how you doing today?
I am doing well. How about you?
Good, thanks. I wanted to get your thoughts on AutoZone. I know they buy back a lot of stock.
Well, the problem is that's kind of all that they're doing right now. They don't have the old mojo. I will admit that they lack that serious mojo per share number that I always like to have. But I will say this. They have hung in here pretty darn well, and I think they continue to buy back stock. And I would still, even at $3,155, I would still buy the stock of AutoZone. I've been right for maybe 3,000 points. I ain't going away. All right, let's go to Mike in Georgia. Mike.
Jim, I'm 81 and wanting to increase my dividends. Would Energy Transfer, ET, be a safe investment?
ET has done a very good job. It's Kelsey Warren. I used to be critical of him. He went on a big buying binge. But I'll tell you, I've been very impressed, very, very impressed with ET. ET, buy home. People are giving up on the industrials. Exactly the moment where the textbook, which is in my head, by the way, but also is available in the book Real Money, exactly when you're supposed to be buying them, not selling them. But that's because people don't know enough, because there's very little history that is taught about the stock market. There's much more mad money ahead, though. Could an investment in Zoetis, ZTS, have you barking up the right tree? I've got the company CEO after the earnings. Then it's mad money, not mad politics. But tonight I'm revealing how to prepare your portfolio for November's presidential election. And by the way, this will not be the first time. And of course, all your calls rapid fire in tonight's data center edition of the lightning round. So stay with Cramer.
Don't Don't miss a second of Mad Money. Follow at Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.